If the looming tax season has you scrambling to get a hold of your tax situation, this beginner's guide is where to start. Taxes can be complex, and it's easy to feel that they're shrouded in mystery. But if you take some time to understand how taxes work, then you can use certain tax strategies to your advantage, and this can change how much you end up getting back or paying. In this tax planning guide, we'll share some essential concepts to understand before it comes time to file so that you can plan to manage your money and avoid costly tax mistakes. Welcome back to another episode of Living Fire. If you never want to miss an upload, make sure to subscribe to the channel. What is tax planning? Tax planning is the analysis and organization of a person's financial situation with the goal of ensuring the most tax-efficient outcome. In other words, the goal of tax planning is to make sure you are legally paying as little in tax as possible. Tax planning is something that should happen all year long, not just when it comes time to file your taxes. What you do in the beginning of the year and throughout has a direct impact on the taxes you owe or the tax refund you expect when you file. Tax planning strategies can aim for more than just reducing your taxable income. In some cases, tax strategies can also benefit you by offsetting future costs for healthcare or providing for your retirement. Employing effective tax planning strategies can free up more money to save, invest, or even spend how you please. Tax strategies may encompass both short-term and long-term objectives. Short-term tax planning is year-end tax planning, meaning the things you can do at the end of the income year to reduce taxable income. This can include making extra contributions to an IRA or pre-tax retirement savings like a 401k, prepaying tuition, contributing to a 529 college savings plan, calculating investment losses to offset capital gains taxes, or maxing out charitable contributions. You can also use the end of each year as a time to learn lessons for longer-term tax planning, whether it's identifying tax credits you missed out on this time around, readjusting your withholding for the coming year, or maxing out your retirement contributions over the course of the year so you aren't scrambling before your next filing. Tax planning can keep you organized and keep your finances in order. Hiring a tax professional versus doing tax planning yourself. Determining who will be planning your taxes is an important element in your overall tax strategy. There are instances when hiring a tax professional makes more sense than doing it yourself, but also situations where you might feel as though you can personally handle things. Depending on the complexities of your tax situation, hiring a tax professional may be a smart financial decision to ensure you maximize your tax efficiency. Even the best tax software can't give you the kind of advice a professional can. If you decide to hire a tax professional, you'll need to determine who's best for your situation. Does hiring a CPA, certified public accountant, make the most sense, or can a tax preparation company handle things? If your tax situation isn't complicated, handling your own tax planning is definitely feasible. Even if your tax situation is complex, hiring out could mean you're missing an opportunity to learn. If you have the time and interest, understanding the entirety of your financial picture can be of great value. Often, the cost of hiring a specialist can be easily covered by the tax refunds they discover on your behalf, but hiring a tax professional can be costly if you don't know what you are doing. Bookkeepers, accountants, CPAs, and CFPs will all likely charge by the hour. Prices can range from $21 an hour for a bookkeeper and $50 to hundreds per hour for a CPA. A CFP might charge hundreds to a couple thousand for a comprehensive financial plan, and then $50 to $300 per month for ongoing advice. National tax preparation companies like H&R Block and Jackson Hewitt may charge varying amounts based on location and services rendered. For any tax professional, it's best to call to get prices based on the specific services you need. Regardless of whether you use a professional to help or not, there are still things you need to understand about your taxes. Understanding your financial situation and your options can ensure you have the best chance at taking the tax strategy that's most advantageous to you. So let's walk through the tax forms you may encounter, as well as some terminology that is frequently confused. Basic tax forms you need to understand. Depending on your situation, taxes can require a lot of paperwork, so let's start with defining some of the forms you're likely to see. W-2 form, also known as the wage and tax statement. This document is required to be sent to employees and the IRS at the end of the year. It reports your annual wages and the amount of taxes withheld from your paychecks. W-4 form. You file a W-4 form before starting employment so your employer knows how much federal income tax to withhold from each paycheck. 1099 form. A series of documents known as information returns. There are a number of different 1099 forms that report various types of income other than your employment salary. This includes independent contractor income, interest and dividends, and withdrawals from a retirement account, among others. 1098E form. If you paid more than $600 in interest on your student loans in any given year, you'll receive a Form 1098E from your student loan servicer. 1098T form, also known as the tuition statement. This form reports expenses you paid for your college tuition that may entitle you to a tax credit or an adjustment to income. Form 5498. This form is used for reporting your IRA contributions to the IRS when you save for retirement. Form 1040. This is a standard federal income tax form used to report your income, claim tax deductions and credits, and calculate the amount of your tax refund or tax bill. Form 8962. Use this to figure out the amount of your premium tax credit, or PTC, if you're eligible to receive one. Tax deductions versus tax credits. As you start your tax planning, you will need to understand how tax deductions and tax credits work. While both may offer you tax breaks, they have some important differences. A tax deduction is an amount of money that you can deduct or subtract from your taxable income. Doing so lowers your taxable income and thus lowers your tax liability. There are two types of tax deductions: the standard deduction and itemized deductions. While both types of deductions reduce your tax liability, they do so in different ways. When you take the standard deduction, you subtract a flat amount that is specified by the government from your income. Itemized deductions, on the other hand, are a variety of eligible expenditures that can be subtracted from your adjusted gross income, or AGI, to reduce your tax bill. Common tax deductions: medical and dental expenses, state and local income, sales and property taxes, home equity loan interest, restrictions apply. Charitable contributions, business use of your home, business use of your car, casualty, disaster, and theft losses, work-related education expenses. A tax credit directly reduces the amount of taxes owed, as opposed to simply reducing your taxable income like a tax deduction. There are two types of tax credits as well: non-refundable and refundable. The savings from a non-refundable tax credit can't be used to increase your tax refund or to create a tax refund if you weren't supposed to originally get one. You get a refund only up to the amount you owe. A refundable tax credit can result in a refund when the tax credits are greater than the amount of tax you owe. Common tax credits: earned income tax credit, child and dependent care credit, adoption credit, child tax credit, residential energy efficient property credit, American Opportunity Credit and Lifetime Learning Credit, premium tax credit, or the Affordable Care Act. Standard deduction versus itemized deduction. Let's get a little bit more into the difference between the standard deduction and the itemized deductions now, as knowing which is best for you to choose will be part of your tax strategy. The standard deduction is a flat amount you're allowed to subtract to reduce your taxable income. This ensures every taxpayer has at least some portion of their income that is not subject to federal income tax. In general, the amount you can deduct is adjusted each year for inflation, and the amount you deduct is determined by the government. The amount of the standard deduction you can claim will vary according to your tax filing status, whether someone else claims you as a dependent, and whether you're 65 or older and/or blind. If you're 65 or older at the end of the tax year, or are blind on the last day of the tax year, you're entitled to an additional deduction. This additional amount will also depend on your filing status. And with that, we've reached the end of this episode, all about what tax is and how to plan for it. If you enjoyed this one and found it helpful, remember to leave a like on the video and to subscribe to Living Fire for even more amazing videos just like this one. Thank you for watching, and we'll see you in the next one.